Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, I'll be sharing with you 6 high quality split share funds that investors can buy through stock exchange, and they offer a lucrative return of anywhere between 8% all the way to 18% annual return, which is just remarkable. What's also noticeable about these 6 high quality split share funds is that their distributions are paid on a monthly basis, and they present a wonderful opportunity to create a passive income on a monthly basis. Without any further ado, let's get into this video. Split share funds invest in a portfolio of high quality dividend paying stocks. They use selective covered call writing strategies to enhance returns and lower portfolio volatility. These funds usually offer 2 types of shares to investors: Class A shares and preferred shares. Class A shares offer enhanced capital appreciation potential and may offer high monthly distributions. Preferred shares, on the other hand, are more conservative. They have a steady income stream of eligible tax-advantaged Canadian dividends. Both Class A and preferred shares are eligible for RRSPs and TFSAs and trade on Toronto Stock Exchange. And we are going to take a look at those high-quality 6 Brompton funds that are split share funds. Let's get into it. All right, our first pick is Brompton Split Bank Corp with ticker symbol SBC for Class A shares or SBC.PR.A for preferred shares. For the sake of this video, we are more interested in the Class A shares because that has a higher distribution yield, and that's something that we think would be of more interest for our viewers. So our focus would be on that. The closing price for SBC Class A share was at $13.49 at the time of making this video. And as of March 12th of 2022, it has a distribution rate of 8.9%. Just remarkable. And keep in mind, the distributions for all of these funds are paid on a monthly basis. The management fee for SBC is at 0.55%. And in terms of total assets under management, we are looking at $381 million. Let's take a look at some additional details to understand what SBC is all about. Here, you are getting exposure and investing indirectly by equal weight through a portfolio of common shares of Canadian Big 6 banks. The Big 6 banks have overall outperformed the S&P Toronto Stock Exchange Composite Index over the long term and have increased dividends, which is positive because this is split share funds give you exposure to that. On top of that, it's worth mentioning that Canada's banks were ranked among the soundest in the world by the World Economic Forum in 2016. The Class A shares offer that monthly distribution, which is primarily return of capital, and there's also opportunity for capital appreciation. In terms of the portfolio, you notice almost all of the exposure is to Canada, and the breakdown by sector allocation is mostly to Canadian banks, with some exposure to North American financial ETF and a slight exposure to cash and short-term investments. The Big 6 banks that we talked about include Bank of Nova Scotia, 16% exposure, Royal Bank of Canada, 15.4%, Canadian Imperial Bank of Commerce, 15.3%, Toronto Dominion Bank, 15.1%, National Bank of Canada, 14.9%, Bank of Montreal at 14.6%, and then of course you have some exposure to Brompton North American Financial Dividend ETF. As we talked about their exposure to another ETF, that's where you get some exposure to it. And you're going to take a look at the performance for SBC. These are at the end of February of 2022, and these returns are shown as of that date. For Class A, year-to-date return is at 7.3%. 1-year return is showing to be at 56.9%. 3-year return is at 23.6%. 5-year return is at 15.6%. And these are all annualized, of course, just to bring that to your attention for the 3-year and 5-year, as well as 10-year annualized return of 17.9%, which is quite remarkable. The annualized return since inception is at 13.2%. You notice for the preferred shares, the returns are quite smaller in comparison. The thing with preferred shares, you're mostly looking for a lot less volatility and almost around that 5% mark return. And that's why for us, the focus is on that Class A shares, which we believe gives you that wonderful return through distributions and the capital gain return on capital. You also have some breakdowns of return by different years in the past 10 to 11 years that you notice. All right, with that out of the way, let us just move on and take a look at our second pick. The second pick here is Life and Bank Split Corp. As the name suggests here, you're getting exposure to the bank, 6 banks, but also you're getting some exposure to life insurance companies. Indeed, you're going to get exposure to that, about 4 life insurance companies. Here, again, you're looking at monthly distributions and opportunity for capital appreciation. And the ticker symbol is available at LBS with the last closing price of $10.67. Distribution rate here is at higher at 11.25%. Management fee is at 0.60%, and the total assets under management is at 622 million. Let us take a look at the portfolio to see what we are looking at. Close to 62% exposure to banks, 38% exposure to insurance, and the remaining in cash and short-term investments. Then banks are the ones that we talked about already, but in terms of the insurance companies, we're talking about Great West Life Co., IA Financial Corporation, Sun Life Financial Incorporation, and Manulife Financial Corp., the 4 life insurance companies that you're getting exposure to. Looking at the returns, at the end of February, year to date is showing at 7.2, 1 year at 54%, 3-year annual return of close to 26%, 5-year annual return of 14.5%, 10-year annual return of 21.4%, and the annual return since inception is at 11.8%. Quite remarkable for us in terms of the returns that we saw with this ETF LBS. Next on our list, we have Brompton Life Co. Split Corp. Here, the focus is just on the insurance companies, that the 4 ones that we are talking about and we saw earlier on. So here we are talking about a portfolio consisting of the majority exposure to insurance companies, close to 99.8, almost 100%, including IA Financial, Sun Life Financial, Great West Life Co., and Manulife. I wanted to bring to your attention that the distribution yield rate here is higher at 14.38%, just incredible. The management fee is at the same at 0.6%, which was similar to the one that we just saw earlier on. And the closing price for LCS is at $6.26. These are all available through Toronto Stock Exchange for Canadian investors to take full advantage of. The total assets under management, you're looking at 118 million. And we are going to also take a look at performance, because how good would that be without us covering that topic? And their returns at the end of February for this year to date was down by 1.6%, 1-year return of 22.3%, 3-year annual return of 21.6%, 5-year annual return of 7.5%, 10-year annual return of 31.6%, and the annual return since inception for this fund is at 1.9%. Let us move on to our next pick. Here we are looking at Global Dividend Growth Split Corp, ticker symbol GDV. As the name suggests here, it consists of a portfolio of large capitalization global dividend growth companies, and global dividend growth have historically outperformed the broader global equity market with lower volatility, as indicated here. In terms of the total assets under management, we are looking at 209 million. The management fee here is higher, probably because of that exposure to global companies. We're looking at 0.85%. The distribution rate for this fund is at 10.25%. This is that income that you can expect annually in terms of your overall return, regardless of course, your overall return for the fund, but rather more so on the distribution that are paid to you. These distributions, of course, are paid on a monthly basis. The last closing price for GDV was at 11.71%. If you look at the portfolio, here you are getting that exposure to different countries. Majority of exposure is to US with 61%, close to 12% exposure to Canada, followed by France, Ireland, Germany, Netherlands, Great Britain, Switzerland, Denmark, consisting majority of the holding, pretty much almost 100% of coverage is to those countries. In terms of breakdown by sectors, your biggest exposure is to information technology, followed by financials and consumer discretionary, with the rest showcased here on the screen. And lastly, of course, in terms of your biggest holdings, they are listed here. You're looking at CDW Corp, Canadian Natural Resources, Royal Bank of Canada, Power Corporation of Canada, Broadcom, Paychex, Wannock, JP Morgan, National Bank of Canada, Automatic Data Processing, and so on and so forth. These top 25 holdings here are shown, which account for close to 58% of the exposure. Looking at the performance for this fund at the end of February 2022, the year to date is down by 17.4%. 1 year is showing to be 13.4% positive, 3 years annualized return of 11.8%, and the return since inception is annualized at 9.5%. That's for GDV. And the one that I'm mostly interested in personally and starting to actually build a larger exposure to gradually is DGS, Dividend Growth Split Corp. Here, your exposure is to Canadian companies, the last closing price being at 6.78%, and it has the highest distribution of all of these six split share corp funds that we are looking at 17.7, close to 18% return annually, which is just remarkable. Management fee only at 0.6%, and total asset is $738 million. It's worthwhile mentioning that here with DGS, consists of large cap portfolio of primarily Canadian equities with high dividend growth rates and high current yields. And the dividend growth reflects company's ability to grow earnings and strong underlying business fundamentals. For Class A, you're getting those juicy monthly distributions, mainly from return of capital. If you look at the portfolio, 100% of your exposure is to Canada. And by breakdown of sectors, you're looking at about 28% financials, 15.4% industrials, 12.1% energy, and the rest that are showcased on the screen. In terms of the top 25 holdings, the list is showcased here, but the couple that I would like to point out for you, the highest exposure is to Brompton Global Dividend Growth ETF, the other ETF that we just talked about earlier on, followed by Royal Bank of Canada, Nutrien Limited, Waste Connections Inc., TELUS, Toronto Dominion Bank, BCE Inc., Bank of Nova Scotia, and Thomson Reuters, and so on and so forth. So you'd see the rest of the companies in the top 25, which account for close to 70% of your exposures. Lastly, if you look at the performance and return for this fund, DGS, the year to date at the end of February was at 2.7%, 1 year return of 68.1%, just incredible. 3 year annual return of 24.1%, 5 year annual return of 12.5%, 10 years annual return of 15.7%. The annualized return since inception for this one is at 10.2%, and the breakdown by years also showcased here and shown for you here. The worst return for this one goes back to 2018, which you had 41.3% negative return. In 2019, though, they had a nice rebound and recovery, showing a positive 70.5% return. And lastly, the sixth fund to look at is Sustainable Power and Infrastructure Split Corp, ticker symbol PWI, with a closing price of $9.18, with $59 million in total assets under management. Distribution rate here is at 8.72%. Looking at the description for PWI, it is an actively managed global portfolio of sustainable power and infrastructure companies, and it's the first environmental sustainability and governance integrated split corp in Canada, with a portfolio exposure giving you exposure to US, Canada, Ireland, Switzerland, France, Germany, Great Britain, Japan, and Hong Kong, and the highest exposure by sector being to industrials, followed by utilities and materials. And looking at the top 25 holdings, on top of the list, we have Brompton Sustainable Real Assets Dividend ETF, Prologis, SBA Communications, Sika AG, and Exelon Corp. And the rest are listed here on the screen, with the top 25 holdings forming about 91% of exposure for this fund. Looking at the performance, this is not currently available as the fund has not been actually founded for even a year. It's a fairly new fund and that has been established. And as a result of that, we don't have a ton of details for PWI. There you have it, folks. We had a quick look at 6 high quality Brompton split income funds that gave you annual return anywhere between 8% all the way to close to 18% for the case of DGS. We hope you found this video beneficial and you gained something of value from it. If you did, please give this video a thumbs up and share it with someone who might benefit from the video as well. And of course, don't forget to subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in dividend stocks and avenues for you to gain a remarkable distribution income, as well as investing in real estate and cryptocurrencies. We also talk about ways to reach financial freedom. Thank you, and we hope to see you next time.